Why are we seeing more random events, more spikes of asset classes than ever? And really, I think comes down to the fact that prior to 2020, for many, many decades, we had been managing the situation, both like with the way the Fed had to manage the situation and how advisors, by virtue of that, had to manage the situation. It was a two-dimensional game. I think this concept of balancing on a barrel, right? You put a plank on top of the barrel, and you're either going left or right. It's a two-dimensional kind of balancing act that you practice it long enough, you kind of figure it out somewhat. It's not as difficult a game as when you introduce a third variable. So back then, the variable was either a positive growth shock or a negative growth shock. The variable that was introduced in 2020 was inflation. And we equate that as having to balance yourself on the top of a ball now, right? That is a three-dimensional game. All right. Hello, everybody, and welcome to another episode of Resolve Riffs. This time it is truly a Resolve Riffs episode. We haven't done one of these in a while, guys. We thought that it would be a good idea to revisit some of the discussions that we had last year with regards to the global macro space, how it affects the liquid alternative space, and really just dig into what the setup is now, how our views have changed, or if they have at all. And I have here our CIO, Resolve Asset Management Global, Adam Butler, our CEO, Michael Philbrick, and myself, President of Resolve Asset Management Global, Rodrigo Gordillo. So let's get into it, guys. One of the key topics that we talk about over and over again that I get a lot of flack on is the idea of inflation. More specifically, I think the way we frame it is different and people get confused, but the concept of inflation volatility.
You know
And
what? Actually, before you even go there, I think
sure.
that it's even worth talking about the idea of inflation. And I don't mean like what the macro definitions are and stuff. I just mean like rate of change versus a change in the price
Oh,
level,
yeah.
which I think,
Good
which,
point.
which really gets people confused, right? So most people, or many people anyways, sort of think that inflation means that prices have gone up, right? Well, which is fair, right? I mean, that's what you feel in your pocketbook, and it's what gives you anxiety. You go to the grocery store and the prices are higher than they were a year ago. Maybe your income hasn't kept up. Um, but for economists, they only really worry about rate of change, right? So you could have a major, prices over the last year could have gone up 20%, but if they're no longer rising, then economists say there's no more inflation, right? So when we talk about inflation, we're referring to the current rate of change, not has the price level risen over the past X number of months or years or whatever, right? So, at the moment we had a major price shock for a bunch of reasons. We had huge supply chain shocks because we had shipping shut down and manufacturing shut down during the epidemic, and then we had a major demand shock because governments around the world were handing out money as a substitute for income because so many people couldn't work. But they had all this, now they got all this money to spend. They got all this money to spend, but there's a slowdown in manufacturing and shipping. So there's not enough goods and services to consume. So we had this price shock. There's a bunch of other dimensions of that. We don't need to get into all of it. But I think that's what we sort of saw in early 2022, right? So as everyone was now paying attention and there was emotional salience in early 2022 because there had been this major price shock. And what we've seen over the ensuing sort of 18 months is that the rate of change of the price level kind of peaked in mid 2022. The rate of inflation has stayed high, but it has come down, right? So the year over year price change is is going up at a much more moderate rate now. And so now the markets are not so fearful about a continued acceleration in the rate of change of inflation. And the Fed has become more comfortable about that as well. And they're beginning to change their position on monetary policy, right? So
Yeah,
that's
that's
what's a
good
very
background.
TLDR over the,
But it
last.
is super important to talk about that because even the president of the United States, or at least his Twitter account, isn't getting it right, right? This idea that people are expecting a reduction in prices. They want prices to go back to what they were prior to 2020, but that's kind of not how inflation works. Prices just go up. The question is whether they're going up
Well,
at a
they
rate
can
of
go down. I
inflation.
mean, I think in
But the
Argentina, we
price level,
may see prices go
sure.
down pretty
But
substantially in
let's
the short term, right?
But
But
in developed markets, I mean, I think people look at gas prices going up and down to previous levels, right? And
right,
so they see a single line item that goes down, and they're thinking, "When's my fruit price gonna go down? How is it that my household is spending 20% more than they did 2 years ago, and why isn't that going down?" Well, it's never gonna go down. What's happening is you're gonna ask for a raise. You're gonna ask for higher
Wages.
wages
Yeah.
so that your discretionary spending can remain at pace with that new price appreciation as the basket of expenses. And so, I think this the people who are clamoring for lower prices just simply are having a hard time understanding what reduction in inflation, and that's partly the industry's fault in terms of language. And when they say inflation has reduced, they're not talking. The average person thinks they're saying prices are going down when what we actually mean is that the price appreciation has tapered somewhat.
Right. It's the variance around that steady rate. And it's been in the narrative that the Fed has had to dance around. To me, it's been plainly obvious that, Adam's foresight on inflation volatility being the thing to focus on was bang on. The inflation is transitory. How transitory is it? Well, it's so transitory that we had to raise rates faster than any time in history because we kind of shit our pants a little bit because it didn't look transitory, even though we were talking it up as transitory.
Right.
That is the inflation volatility that Adam brought to the forefront for us to chat about a couple of years ago, was the fact that the rate can be 2%, but how wide is the bell curve around the 2%? Sometimes it's 0 and sometimes it's 6 versus just being 2. And from 1982, the falling of the Berlin Wall, the opening up of China, the globalization of the world, providing so many disinflationary types of opportunities for markets to take advantage, lower interest rates. That paper by AHL Fire and Ice just showed how little inflation volatility that we had over such a long time frame, where the participants of the market didn't have any real experience with it. And now we're conversely in another environment, and inflation could run at the same rate it had prior to 2022 with a much larger variance around it. And that changes everything. It changes the volatility of asset classes. It changes the correlation relationships with those asset classes. And that has occurred. I mean, that has happened. We have rates that were 0 and then we're 5, maybe 4 in the US, but around jigs and rails, if you wanted to take a little bit of credit risk and whatnot, you could get more than 4, but let's call it the 10-year. You came to 4, or the 2-year rather. That's a pretty significant increase. And we're in for more of that. We don't have deglobalization. The Berlin Wall is not falling. Ukraine has been invaded. Taiwan is saber rattling. We've got all the things in the Middle East that are adding to the opportunity for simply more variance
That's
around
right.
the average.
And I think, one of the analogies that we used back then that I think is important to bring back to the forefront is, I was in a podcast interview yesterday, and I was asked, like, why are we seeing more random events, more spikes of asset classes than ever? And it really, I think, comes down to the fact that prior to 2020, for many, many decades, we had been managing the situation, both like with the way the Fed had to manage the situation and how advisors, by virtue of that, had to manage the situation. It was a two-dimensional game. I think this concept of balancing on a barrel, right? You put a plank on top of the barrel, and you're either going left or right. It's a two-dimensional kind of balancing act that, you practice it long enough, you kind of figure it out somewhat. It's not as difficult a game as when you introduce a third variable. So back then, the variable was either a positive growth shock or a negative growth shock. The variable that was introduced in 2020 was inflation. And we equate that as having to balance yourself on the top of a ball now, right? That is a three-dimensional game. And while it is possible to do if you have the right portfolio, the right balance, the right preparation, the right prediction, it is going to lead to a lot more jittery balancing acts, and you're going to be caught offside more often than you have in your previous investment career. And introducing this inflation variable will need will require allocators and investors to really throw away their intuition as to how they think the markets work, based on their personal experience. And they're going to have to start digging into, wait, how does the market actually work during periods of inflation volatility, like the 70s, like the 40s, like 1920s? And when you examine that, you realize that, hey, it's just more volatility everywhere. Asset volatility goes up, whether it's on currencies, equities, commodities, bonds. And as assets volatilities go up, there's opportunity sets, but there's also risks if you are still playing that you know balancing on a barrel game. You're not gonna find the same success. So I think the question that we started with is, has our thesis about inflation changed? No, the thesis was not that it was going to be an inflationary period. The thesis was that there's going to be a lot of inflation volatility.
I
So
think
yeah, we're
people
kind of
may be
sticking to our guns there.
mistaking the current waning of the rate of inflation for um, the Fed or the authorities or easing of economic situations that were exerting artificial constraints. All these variables are sort of conspiring to tame inflation permanently. And I think at this point, what's more likely is that we're just, as we said, inflation is going to have a wider range of outcomes than we're used to over the last 2 or 3 decades in the next decade or so. And we're just happen to be sort of near the trough of one of those waves, right? Um, for whatever reason, the Fed and probably a variety of other um, dynamics, we've had a slowing of the rate of inflation, and people are becoming a little bit more sanguine right at the point when it looks like growth is beginning to reaccelerate and inflation is beginning to reaccelerate, especially on the wage front and in important service sectors of the economy. So, we could easily go back to some of the dynamics that we experienced over the last few decades. I mean, look, if you wanted to buy a TV 10 years ago or 20 years ago, you can buy a TV now that is vastly superior than what you bought 10 years or 20 years ago for either the same price or a lot less, right? So, manufactured goods, especially, technology driven manufactured goods have continued to go through deflation, right? Especially when you adjust for the utility you get from them. But we don't really make a lot of new humans. And so the humans are involved in the service sector. And oftentimes you can't really scale what a human does from day to day, right? Now, new technology might be able to um, implement some pretty substantial changes to that over the next 5 or 6 years. We could get into what is happening in AI, but at the moment, you can't really replace humans further in terms of the service economy. That is where we continue to see uh, a reacceleration of growth and a reacceleration potentially of some inflation dynamics. So we shouldn't get sanguine just because we've seen inflation tame over the last little while. We're probably just at the trough of a wave and about to see it reemerge.
And I was just kind of reviewing some of the notes I had on that IMF paper that went back 100 years to review 100 inflationary shocks across all the major countries. And one of the things that they found is that, number one, we don't nail the inflation problem on the first try. It just doesn't happen. There's both structural reasons why not, and there's political reasons why it's really unpalatable and difficult to do. And so it doesn't matter who you are, you're probably going to have a few tries before you put that genie back in the bottle. The other interesting thing is that those countries that actually did a good job of aggressively dealing with inflation ended up having a negative growth shock that was more pronounced initially, but a significantly higher growth rate 5 years later, versus countries that did not have that. And I don't think, as you look at the landscape, especially, I think it's more pronounced in Europe, where they have their economies have been much weaker than the US, where they've actually stopped raising rates even when the inflation rate was still higher. And we're starting to see the impacts of that. And by the way, that speaks to that diversity in policy speaks to that what we were chatting before, how it's likely to be higher volatility across assets than we've seen in the previous 10 years, right? It's not as uniform as it used to be. And so, yeah, I think we need to get used to the fact that right now we have strong economic growth still in the US. We have a low unemployment. We have continued stable wage growth. And yet we have 175 basis points, 200 basis points priced in terms of cuts in the next 12 months, right? This is the type of confusing signals that one gets. Is it over? Have we hit our inflation marker? Is the Fed going to reduce rates when inflation is still going up? Are they actually going to ease? Right. So it really is structurally difficult. And then we're going to an election year where people like Yellen have actually pulled levers to stimulate the economy when Powell is actually trying to put the brakes on. So we can see how it's becoming more and more difficult on the inflation side to navigate this easily. And so it really comes down to what can investors do when we don't know when the accelerator is going to be pushed and when the brakes are going to be pushed, or when they're both going to happen at the same time. Um, so, any thoughts on that, on how what it looks like for investors and what investors can do to deal with that environment?
Well, I mean, the first and foremost is to think through diversity in the portfolio, which is always very difficult at times like this. The assets that have treated you so well for so long, and now you're going to de-emphasize them, and why now potentially is the challenge. So, return stacked, and return stacking is about not having to sacrifice that. Again, when you think about the discussions lately you've seen around valuations, and valuations of what obviously is a very important consideration there. So US markets, they're at high valuations. They're not the highest valuations. They're at high valuations. Well, what do high valuations mean? Well, they mean that future returns are probably lower because you pulled those future returns into the present. And that's why valuations are a concern at the moment. So if you're going to ride that momentum wave of AI, tech, US equities, you should be quite diligent about managing the risk associated with those positions. Because when a strong trend upwardly with high valuations becomes a strong downward trend, that's where you get periods like 1929, 2000, Japan circa 1990. This is where you get wealth altering events that are wealth altering in not the way you like. And so if you're going to take the chance of saying, well, the trend is still so strong, okay, that's great. Well, then you better have some other risk management techniques going into the portfolio, something that's going to counterbalance that. Now, you could take the view of, well, let me look further afield. Let me look into small caps. Let me look at value. Let me look at foreign. Let me look into emerging markets. And there you see valuations that aren't stretched. Actually, you might even see downright discounts. But it's, again, we come back to the turkey story. How does the turkey know when Thanksgiving's coming? The farmer treats him real well, and it gets better and better until it's Thanksgiving. And so this is not an easy challenge, and it's a behavioral trap of recency bias and overconfidence. Happens every time. Investors today are expecting 15% return over the last 5 years. Why? Because they've got 15% return over the last 5 years. What's the long term? The long term's 10. These aren't real, obviously. These are nominal. But if you did 10, you have to do something else in order to get if you've done 15 rather, to get back to 10, you've got to spend some time below the average. And those corrections happen one of two
But that's
ways.
10 real, right? Like 10 real versus the long-term equity risk premium real is more like 4.
Oh,
We
of
got to go
course, of
back
course.
to like
And
what is
all of
that?
that is valuation. All of that excess return is increased valuation. Now, those correct through either time or price. So either you get a very long period of not very good performance while valuation catches up, or you get a significant decline in the markets. And those types of things, we saw it in 2000. We saw the equal weight or small cap stocks actually have positive performance while the S&P 500 was down 50%. It wasn't great positive performance, but it was positive simply because the valuation was way too high in those S&P 500 stocks, and it was reasonable on the rest of the marketplace. which is not too far from here. So an investor has a choice. They can start to think about, those quality factors, start to think about diversity of the portfolio into stuff that their friends don't have, that they don't know, that they don't love, that they don't trust. Or they can start layering on diversifying strategies like we talk about in the return stacked portfolio solutions website and suite, where you take those betas that you know, love, and trust and stack upon them diversifying strategies so that when there's blood in the streets, you actually have something to go buying with.
Yeah. You know what's crazy is as we came into 2022 and saw the biggest rip your face off drawdown in bonds. I mean, was it officially like the largest drawdown for the 30-year treasury in history? I think I heard that. I'm not sure, but it certainly was one of the most aggressive and largest drawdowns.
Yeah, I think you gave back half of the
Um,
returns.
I was at that point, I'm like, that's the lesson. That's where people are like, oh, okay, things have changed. So we dropped equities and bonds, number one, correlated, which wasn't supposed to happen. We had a lot of discussions last year. People were like, when is the market going to get back to normal? And I'm like, that is normal. In a rising rate shock environment. That is normal. You haven't seen it in 40 years. Um, And I thought it was gonna change, the chip was gonna be changed. We gotta figure it out in a different way. I'm scared of just going, 60/40. But what's happened is I think all of those accumulated lessons from the previous 10 years, which is, okay, be recovery from here. And they have been, it worked out for them. They have been
Vindicated.
rewarded once again, right? They've been rewarded again. They're like, I don't know what you're talking about, Gordillo. Like, that was
Um,
just a blip, right? That was just a blip. Don't worry about that. That's a thing of the past. And I think, the problem there of trying to show things like, hey, commodities actually were the best performing asset class in the last couple of years. Hey, by the way, managed futures is still one of the best performing asset class over the last 2 years, right? It was up. The index, the Stockton Trend Index and CTA Index were up double digits in 2022, and then gave back half of that, maybe a bit more in last year. Well, the lesson is that was momentary. I'm out. No need. That's what I think we're still dealing with today. And if the inflation volatility thesis plays out, that's not the only time it's going to happen, right? It is exactly within the thesis. And now, how do we get people to diversify, right? To just move away from that equity bond exclusive
well,
portfolio.
let's maybe not let's not let them make the move away. Let's stack some things on
Boom.
top. And I think
Well, I think
that,
that is the solution, right? It's
yeah,
like you gotta.
yeah,
How do you get people to
because
move on this? So you don't get them to move.
yeah,
You just get
well,
them to put it on top. You don't get them to sell and get out. You get them to put it on top. I'm just still bitching because, God damn it.
the reality is too that things can always get more expensive. So if there's one thing that I think all of us have learned, like if you think the Nasdaq was expensive, go look at what Japan was. It was 60 times or 90 times, whatever the ratio you wanted to use. I think it was Cape Shiller or whatever it was. But it was a full 60% higher than what happened in the Nasdaq and the S&P. And it's interesting. So when you look at, sort of a statistical background and say, well, if you have high valuations, does that in fact, in the short term, lead to anything? And it's like, no, it doesn't mean anything really. A lot of the times it means it's going to get more expensive in the 1 to 5 year time frame. In the 10 to 15 year time frame, it's kind of like gravity. But there's that meaty middle. And if you look at a scatter graph of that chart, you'll see all of these high valuation, high returns, which came in the late 90s,
Yeah.
where it just got more and more highly valued. So we could be in the same situation here if we get into a world where we just start printing money as we kind of have, where things could go to a place where you think people are in a zombie-like trance now following these AI stocks. We've seen it. This can get way, way more
What does
cultish.
Cliff say? It can get to 110th decile
Yeah, at
valuation,
least.
right? Way more than 100%.
Yeah.
But the value is an interesting thing in terms of sequence of return of value returns. I think, Adam, you've done a lot of work on this, on valuation, CAPE ratio, and trying to like assess the forward returns over a 5-year, 10-year, 20-year. Can you I kind of feel like value is one of those things that you get all of the returns in like a few months, once every 10 years. And you look at Warren Buffett's outperformance, it feels like it's not like you're gonna get a little bit of that sugar every year. It's almost like you get it all of it in once every 10 years, and then you suffer again for another 10. But maybe that's
This
just
is,
my
well, there's a couple of
intuit.
different things going on, right? One is sort of, I think what you're referring to is the character of the value premium,
Yeah.
right? Absolutely. Yeah. Value is one of these things where you suffer sort of 80% of the months underperforming the market. And then you've got kind of like a 6 to 8 month period that if you miss it, it delivered all of the excess returns that you're going to see for that decade. Right. Um, so you really have to hold your nose and stick with it. A lot of strategies are like that. In fact, I would argue that a big chunk of why you might expect to receive an excess return on these strategies because they're hard to hold and most people don't want to hold them, right? So they're underowned, and when something's underowned, it means that you require a higher return in order to entice people to own it, right? And so, I think that's just the nature of it. Trend following can be kind of the same. Momentum's kind of the same, right? Like people, it just hurts to be different from your peer group. And it especially hurts the longer that you are accumulating that difference, especially if that difference is negative. So, I think that's a quality that you need to endure in order to be able to expect to generate higher than um, market returns. And then, in terms of the profile of markets when they are expensive relative to their sort of historical CAPE ratio or what have you, I think Mike nailed it. For the next year or so, the the likelihood is the trend's going to continue. It's going to, you're going to get more expensive, not less expensive. And but it's uh Buffett's mentor now that I can't remember his name of. It's like
Graham?
Charlie
Bill,
Munger?
yeah, Graham,
Oh, no,
who
no.
said it over
Billy
the
Graham.
long term. Yeah, right. The market is a weighing machine, right? So you just have to wait for it to start weighing instead of running on emotions. What makes the current environment so especially challenging for those of us with a sense of history is just how concentrated. Like it's not only just that the only returns are coming from U.S. cap weighted equities. It's that it's coming from like 10 stocks. Those 10 stocks represent more of the index than any 10 stocks have ever represented. So, they actually end up representing approximately the average amount of the index's earnings over the very long term. The top 10 stocks do historically generate a disproportionate percentage of all of public publicly generated earnings. But um, the market cap of these companies is just so wildly out of whack. And it's not like you've got a diversified, at least in back when the Nifty 50 was in vogue, you had conglomerates with very high valuations, but those conglomerates owned divisions across a wide variety of different segments of the economy. Whereas you're very narrowly exposed to a group of tech stocks that are in turn very narrowly exposed to the future of AI. I mean, I happen to have a strong view on how well AI is going to play out, but whether that translates directly to the bottom line of a few tech conglomerates, I have a great deal of suspicion about. So, it's a very concentrated bet. And it's concentrated, and then it's concentrated, and then it's more concentrated. And so, I just find it particularly scary at this point. I want to diversify more than ever, but it's more painful than ever to be diversified.
Yeah,
Yeah.
it's like that.
It's the railroads, it's the internet,
Okay.
it's the, as I know you pointed this out too in the past, Adam, same 500 stocks, you equal weight them over the last year, you get 6%, you market cap weight them, you get 22.5. It's the same five stocks. So obviously market cap is dominating. So what's that? That's the valuation of those stocks increasing based on the potential for their earnings to increase down the track. Boy, oh boy, starting to sound like Cisco, Sun Micro, Nortel. I mean, this dance is getting very familiar.
It is, and
It's a
it's
good
that
it's
it's
a
that
good analog
discussion of like
actually.
this time it's different. It's this time it's different. You don't we're not valuing
Yeah.
things the same way we used to, right? We got AI now. It's different. We got Bitcoin.
Just
It's
like we had
different.
the internet, right? I know
Exactly.
the internet was a major thing and it ended up accruing profound value for all of humanity and generating massive productivity gain, but it just didn't accrue to nearly the extent that investors were betting to that small number of companies that were getting all of the benefit of the
Yeah.
doubt back in 1988, 89.
What do you mean? Look at Netscape. Wait, wait,
No,
wait.
but this is an important discussion that kind of ties into that misunderstanding of how inflation works. And we had this discussion with in our last podcast, you, me, and Jen. Who was it that we were?
Bianco?
No, yeah, Bianco, right? Which is, look, you should be careful with investing right now, but the economy is fantastic.
Mm,
Right? Like there's a big difference between an economy doing well and what your portfolio is likely to do or what level of danger is it in, right? I think Mike, you used to use an analogy and not a historical analog here, which is from something like 1966 to 1997, the Dow Jones annualized at, so let me get this straight. 66 to 82, Dow Jones annualized at 0, 82 to 97, it annualized at 16. Growth rates for the first portion of that was about 5. Growth rates for the second portion of that were around 5. Like, the economy isn't
GDP
necessarily
growth, real
yeah.
tied,
GDP. Yeah.
right? Isn't necessarily tied to what's gonna happen in your portfolio. I think that it's what's priced in, and this is something that Bob Elliott keeps on harping on that I love, where he's like, "Well, what do you think? What's the setup, and what do you think is happening right now?" It's like, what's more important is what the market is not pricing in right now, what
Mhm.
it's getting wrong, and that's how you make money in the market. And I think what this you could LLMs and machine learning and the tech stocks could be huge for humanity and still be way overvalued and make you zero money over the next 10 years. It could happen. And it has historically happened over and over again, but momentum's a bitch, right? So it could last a bit longer than what we think.
It was argued that the part of what happened in the Great Depression was a function of the Industrial Revolution and a function of the fact that you did not need all that labor on the farm. The family farm became obsolete, but there was no place for those workers to go. You had a tractor. You didn't need a horse. You didn't need a family. You had a tractor, and you had the amalgamation of all of these family farms, which left quite a number of people displaced. It's not the only reason, but boy, oh boy, if you start displacing 3 or 4 or 7% of your employment force because you can make the remaining 95% more efficient through the use of AI, and then you start to interplay robotics into that, um, there's a dislocation there that is not it's this is not talked about very often, and it's not unusual. Happened with the telephone. It happened every time there has been a major leap in some sort of technology. Oftentimes, it comes with a displaced workforce that needs to be retrained, and how big that workforce is and what the infrastructure is within the country to retrain it, or what the policies are around reeducation and retraining, are incredibly important points to mitigate those factors. And it's not being talked about. But if AI is this boon in productivity, okay, well, does that mean we're all going to make more, produce more, and everyone's going to consume more, and it takes less? Or will some portion of the labor force be displaced for a period of time? And that's
Yeah,
a
like the
question.
addition of all that could be a reduction in productivity for a short period of time until we get an outstripping of productivity that'll help reduce, government debt and all these wonderful
Yeah.
things that productivity tends to do. But this is the thing about preparation and prediction, right? And I think
Mhm.
we've been talking about all of these continued gaps in understanding of inflation and how valuations work and what it can. It's really tough to then know how to position your portfolio to benefit from these understandings, and it's really really difficult to do. So the first thing that we always advocate for is make sure, like, I mean, if you guys are listening to this for the first time, the key thing to take away is you got to put most of your effort in preparing your portfolio for those shocks. And so you got to have something for bull markets, which generally tends to be, equity indices, globally diversified, hopefully. right? So that's another thing. Is it going to continue to be U.S. domination? Probably not if history is any indication. You have to have something for bear markets, and this goes back down to not credit but government bonds, right? When there's a non-inflationary bear market and panic ensues, people give money to the government and they start bidding up bonds, government bonds across the G7 especially, right? So you have that opportunity set to protect your portfolio in bear markets. And then the third one is commodities in periods of high inflation shocks. And we saw the benefit of that in the last couple of years, right? That's preparation. I think, we used to talk about prediction in the context of our alpha sleeves, but I think we can talk a bit more about preparation with the introduction of trend replication strategies, right? So I think that's more now become a bit of an alternative beta that has a set of characteristics that we can count on to be there in periods, especially of pronounced trends, a prolonged and sustained trend like we saw in the first quarter of 2022. We saw in '08, in periods of duress, trend following managed future strategies tend to be really, really good in bear markets, multi-month, multi-year bear markets, as well as inflationary shocks, because 50% of what they trade is in the commodity space. So I would say in terms of preparation, we have to consider as investors a solid diversified equity portfolio, a solid diversified government bond portfolio, a solid diversified inflation portfolio that should include that trend following portion. And that's a hybrid one because it also tends to help bonds, right? So it's kind of like it straddles commodities and bonds in terms of its benefit as a preventative measure, as a preparation portfolio. And then just make sure you're not letting the maniacs take over the asylum, as we've always talked about. Don't overweight one allocation from a risk perspective. So those that are highly volatile should get less, and those that are lowly volatile should get more. Right, and that's the beginning. I think for me, I'm kind of that's set. If I had to tell my wife, listen, I got one day to live. What are you going to do for the? This is what you're going to do. You're going to allocate to something like this. Talk to your advisors. This is not investment advice and all that, but my wife would get a very simple portfolio, and
So is it your
and
wife that has one day to live or you? I'm
well,
kind of
that's it. It depends on the day. You see how I feel about that? So I think
Yeah.
the message here is it's going to be complicated, right? And you got to start with that. I think that's how you minimize the shocks that you're going to get, and and then we can try to add more innovative ways to diversify. And we can talk a little bit about the replication world that's coming out.
Mhm.
Mike, you had some thoughts there that make it even more valuable these days to really think about
Sure.
that space. So why don't you tell us a little bit about that?
Well, I think that, when you think about harnessing the trend factor via managed futures managers, commodity trading advisors like we are, you're thinking about harnessing both long and short exposures across bonds and stocks, currencies, and commodities, like you already mentioned. In the past, these have been harder markets to take advantage of, and they've had higher fees associated with them. So in our trend replication paper, we go through a process of thinking through how you might replicate those return streams. And there's a bottom up method and there's a top down method. And you get very high correlation to the trend factor in the CTA space. But the nice thing is you're picking up a massive fee alpha, because in the replication, if it were a product, let's say the product is done at 1%. But if you're trying to replicate the B Top 50 or the SOC10 Trend Index, those indexes actually include real managers, but the real manager's fee is 2 and 20. So let's say this year is like 2022. We have a really difficult year for stocks and bonds, and the trend factor does really great. Well, if you're in those higher priced managers, let's say the return is 20%, and I'll play a little fast and loose with the numbers. Well, you got a 20% performance fee minus a 2% management fee. You end up with 14%. That's great in a year like 2022. Boy, up 14, especially when the world, fell apart and down 25. If you do it through a trend replication process and save the fee, let's call it 1% fee, you're now up 19% versus 14. That's 5% in fee alpha. And we have to remember that you pay the fee when you make the money. And when you make the money in these types of strategies is when the rest of the portfolio is really suffering. So where do you want the 5%? You want it in your portfolio, not the managers, because that gives you the opportunity to rebalance. It gives you that extra money to buy when there's blood in the streets. It also prevents you from making the error of buying one of the managers in the dispersion where, if the average is 20, one got 0, one got 40. If you have this diversifier that put up a 0 in a difficult time, that is going to be a really challenging conversation for the asset owner if you're the advisor. Now, larger asset owners can buy many of these managers and diversify across that. But RIAs, registered investment advisors, smaller DIY investors may not have the capital to be able to allocate to these very large managers, $5 million at a time.
Yeah.
And so the process of replication gets rid of the dispersion, and it allows for a higher capture of the upside when you would pay the fees and when you want that upside in your portfolio.
That's an interesting point that I hadn't actually zeroed in on until we did the analysis, right? Like, where is the fee alpha? Obviously, I mean, you just needed to look
Mm.
at it, but it was like, oh, right. You're when SOC Gen, Trend Index, whatever index you're following is going sideways or down, there's not a lot of difference, right? It's already, I thought there was some value in doing some replication. What's going on? So the value accrues. Most of the value does really accrue when it's these massive upward swings,
Upside capture.
and it's and it's Cliff's saying, it hurts when it hurts to get hurt, right? That's generally what value, I think, investing is. But in this case, it pays when it hurts to get hurt, and you want to get paid the most when it hurts to get hurt. And I think that's the fee alpha. There is a crucial thing to contemplate if you're thinking about allocating to those type of strategies. I want to move on to other things. So we talked about, I think, the basis of a do no harm portfolio, a Hippocratic oath portfolio that you can count on. Um, there are other things that we can do that we've liked over the years that we've implemented internally, and Adam, you did a great summary of this a couple of years ago for us, but I want you to kind of talk about it again, because if you think about diversifiers, what is it that you want to continue to add on once you have your prediction portfolio down? You want to add on things that have a positive expected return, that have been true, tried, and tested in history. You're not kind of creating it out of thin air and hope that it works. And you want something that is lowly correlated to your existing sleeves. And one of the things that keeps on coming up in our radar is that carry strategy, or managed futures yield or alternative yield. But can you walk us through again? What is carry? Why we think it works? Why we think it exists? And maybe we can talk a bit about some of the benefits of including it into a portfolio.
Yeah, I mean, there's a number of frames to explore the concept of carry. A good place to start is from the do no harm portfolio that you described earlier, where you kind of have an equal amount of your risk in assets that do well in inflation shocks, an equal amount that do well in positive growth shocks, and another that do well in negative growth shocks. So you've got the sort of equities, commodities, bonds. And the idea there is you just sort of assume that over the long term, there's a duration premium. In other words, investors require a higher return to lock up their money for longer. So longer duration bonds on average typically have a higher return than shorter duration bonds, require an even higher return to put your money in equities because you're taking on this growth risk. 5 years could go by and the value of the portfolio is lower today than it was when you invested in it because you don't know what the trajectory of that price evolution is going to be. Um, and that over time, because of the steady drum of inflation, commodity prices are going to rise. But there actually are a double handful of extended periods over the last 100 or so years where those basic assumptions they're not true, right? And we just went through one in 2022. So, like I said, typically longer duration bonds have a higher return or a higher yield than lower duration bonds. Well, at the moment, and for the last couple of years or so, that has been reversed. And so investing in longer duration bonds and locking up your money for longer has actually earned you lower returns than just keeping your money in T-bills or 2-year bonds, right? So why are you taking more risk for less return, right? That equation is inverted. In commodities over the long term, you do end up earning a roll yield because um, the near term commodity is at a higher price than the commodities, sorry, than the contracts that are further out on the curve, and that as those further out on the curve contracts roll up, they approach the being the most recent contract or the nearest term contract, they approach the same price as the near term contract. So they roll up in value, right? So you earn this kind of roll commodity yield. But a lot of the times commodities are that is inverted. And so you actually, if the price of the commodity, if the spot commodity doesn't change, you actually want to be short the commodity because the far away contracts are higher than the spot and they're going to roll down and you're going to expect that price to come down. So, the idea of carry in this context is, well, yeah, you want to have equal risk allocation to all of these different areas of the economy and different financial markets for these diverse reasons, but you don't always want to be long them. Sometimes you want to be short them, right? And so carry is just the return that you expect to get on a market if the price doesn't change. In equities, it's the dividend yield. In bonds, it's the coupon. And in commodities, it's this roll yield that we discussed, right? Well, most of the time, this duration premium in bonds is positive. Most of the time, the equity risk premium is positive. Dividends, the dividend plus shareholder yield is higher than the risk-free return, et cetera. You just want to be allocated to all these different asset classes, but in the direction of the expected premium, right? Yes, most of the time that premium is positive, but carry, because it allows you to go short, gives you a chance to earn that premium when the sign flips on it, right? And I mean, there's a good question on why this premium exists, especially in commodities. And I really like the idea that carry in commodities is a win-win. It's a win for producers and it's a win for speculators. It's a win for producers because they want to sell their production forward to lock in a price and have visibility on what their earnings are going to be. And the equity and credit holders that supply those producers with the capital to run their business really like having that earnings visibility because their earnings volatility is a lot lower and they've got a much higher probability of being able to deliver those dividends and pay those coupons to the money that loan those firms the money to operate. Um, and so those companies are willing to pay speculators a premium in order to take on that price risk. They lock it in, the speculators take on the price risk. And so speculators get paid basically for selling insurance on the earnings of the producers. The producers make out, and the speculators make out because they're selling insurance and earning that premium, right? So, you know, it's great to think about carry as just a really great way to get access to a diversified basket of asset classes in the direction that they are currently paying that premium, right? Rather than always assuming that that premium is positive.
Sorry to interrupt, but I did want to take a quick second to remind listeners that while we do absolutely love providing our audience with world class guests and weekly investment insights, we wanted to remind you that we actually do our best work outside of this podcast. And we try to do this by providing cutting edge, globally diversified, and systematic investment strategies that are designed to be broadly non correlated to traditional equity and bond portfolios. So we actually manage private and public funds, as well as bespoke, separately managed accounts for investors that seek the potential to smooth out portfolio returns in the long run. So if you do want to see that theory that we've been talking about put into practice, please do go ahead and check us out at investorsolve.com. Now back to the podcast. So
You're
that's
keeping
a
me in
great
suspense.
summary. It's a great summary, and I think the example for the average investor of the carry of a stock being the dividend is appropriate, right? You look at a stock that pays a 5% dividend, you don't necessarily expect to make 5% total return on that stock, right? You could make a 5% dividend, and at the end of the year, that stock have gone down 5%, you made zero, right? So the crucial point here
Ooh.
The definition of carry being what you expect to make if the price doesn't change. But of course, price does change, which makes it's not a no-brainer, right? It is, again, you're taking risk. You could have years where that bet is not paying out off for you. In Canada, it's everybody's enamored with the big 5 banks and their big dividends and their consistent dividends that, in 2008, you had -55 to -75% drawdowns in those banks. It is just another risk premium that you're taking, the importance here being how closely correlated is that risk that you're taking to achieve that long-term return by choosing futures contracts, whether they're in contango or backwardation, right? So whether you're getting a high carry or a low carry, what is the correlation to everything else? And it turns out it's extremely low when you're using a diversified set across commodities, currencies, equities, bonds, and the decision making is different than the decisions you're taking for everything else, right? You're getting an equity risk premium based on, you know, economic growth. You're getting a term premium based on the fact that the longer term bond is paying more than the shorter term bond over time, not all the time. And on trend, you're making your choices as to whether to be long or short a futures contract on anchoring and adjusting, herding effects. These are cascade effects that tend to explain human nature and people wanting to pile into something for a short period of time. Well, it turns out that the decision to choose something to go long or short based on carry is very different than trend. And therefore, even the correlation between carry and trend is quite low. I think our internal numbers show something around 0.25%, right? So very, very accretive. And and you see that the combination of those two is kind of killer. It's not surprising that a lot of trend managers started adding carry more and more to their trend following strategies. Not a lot because it does have a different character, but it is useful. So anyway, I just
Carry
want
got a
to kind
bad name too because, it was
of
for the longest time, it was associated with currency carries. So you've got managers who are effectively long, developed market currencies and short emerging market currencies. And the emerging market currencies pay a higher yield than the developed market currencies because they've got more currency volatility. They typically have higher inflation dynamics for a variety of reasons. And so you could you know, own these emerging market currencies with high yields and borrow in developed market currencies and earn that spread, right? Well, the thing is that the profile of that return stream, um, to Rodrigo's point earlier, is such that it hurts when it hurts to hurt. And so you want to have a more diversified basket of markets that you're using to be in the direction of this carry, right? We in a diversified carry strategy, you do have currencies. Adding emerging market currencies does change the character of a carry strategy. We don't actually invest in real emerging market currencies in our carry strategy for that reason. But there's just so many different bets you can take around all of the different global bonds, global equity, and global commodity markets that when you have all of them in the portfolio, you don't have at all the same
yeah.
character you had when it was just that kind of currency carry, right? So, carry gets this bad rap because it was a very different strategy than what we described. We talk about kind of global carry, right? And I think it's
It
important to make
is
that distinction.
interesting. People who don't know it, don't understand it, you kinda explain it to them on the dividend side, they get it. People who have heard carry, they immediately say, "Oh, yeah, but that'll blow up in your face." 'Cause actually, I don't even think they think about it as, like, emerging market and domestic currency. I actually think about it's a yen-US cross, right? That is kinda steady, 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 and then you're gone. And so every time I bring up carry, they're like, "Oh, that's dangerous." And, the quote that I always use is, "It ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so." And I think that carry falls into that category. Um, because there's also one other thing that adds to that story is that allocators didn't love, for example, when Winton started adding a lot of carry to their strategy because they wanted that crisis alpha. And so I think the takeaway from that line in the newspaper was, "Oh, Carry must lose all of the money that trend gives you." And I think when we look at, I've just kind of gone through all of the major years of pain for equity markets, and it's not that it loses, it's that it makes less. It is the trend tends to be more trendy. It tends to like, "Oh, that's exploding upward or downward. I'm gonna go long and short that aggressively." Whereas Carry's taken a whole different approach. It's still trying to be an absolute return type of product. And most years where we've seen bear markets in equity markets and when we've seen negative growth shocks, CarryStrategy muddles along quite nicely. Not always, but most of the time, yeah. So I think we need to, it just ain't so that Carry always loses money when there is a negative growth shock.
Oh, it's yeah, most of the time it
Not even
doesn't. You
close.
know, it really is very uncorrelated with stocks and bonds and a very effective complement most of the time. You know, it's not the only premium, right? I mean, I love a variety of premiums. You know, I think eventually we'll probably add something like merger arbitrage or a convertible arbitrage, or you know, there's the fallen angels premium. Like, there's a number of really great
Yeah,
risk premium out there, and you know, people should be seeking all of them, right? But in that basket, I would put trend at the top, and I would put carry right next to it. And
100%.
so I'm excited to be on the verge of offering both of those to investors for stacking purposes. And you know, as you were talking earlier about the optimal or do no harm portfolio, and I know we've been talking and harping for 10 years about this global risk parity portfolio, and it's, you know, it's what we all prefer. And you know, I don't think it's still in our hearts as it takes center stage. But I do like the fact that, you know, we've got solutions for people who just aren't ready to go, you know, to move far enough away from that sort of more traditional 60/40 orientation. And that trend, the return stacked concept allows them to preserve that 60/40 that they've come to love. So, you know, they just want to hold on to it because it's been so good to them for so long, right? I get that. But you don't need to let go. You can put something on top. You know, you can already stack the trend on top. You can very soon you'll be able to stack carry on top. And you know, there's lots more coming down the pipe. And I think people should really start to, if you're not ready to go right to that global risk parity portfolio that we all three know and love, and you know, lots of devotees among the sovereign wealth managers and largest hedge funds in the world. But if you can't quite get there, return stacking is a really good place to start.
So that's actually a point I wanted to hit today. So you nailed it, right? We are all terrain lovers. We want everybody to invest in this very weird high tracking error portfolio that, it doesn't matter which all terrain, whether it's a permanent portfolio, adaptive asset allocation, cockroach, or otherwise, in the last 2 years has avoided most of the pain, but it's kind of flatlined, single digits, maybe flat returns in the last 2 years, avoided most of the pain. And people are like, well, what that was all terrain. That's a type of pain that you get when you invest in something that weird. But the other thing that is really interesting about this concept of stacking is for those who don't want the all terrain, who have spent their careers or their investment careers as individual retail investors trying to beat a benchmark. Let's say you're trying to beat the S&P 500. For the longest time, forever, the way to do that is what? Stock select, right? There's 500 stocks. Here's what I'm going to do. I'm going to choose a style, growth investing. I'm going to have a subset of those 500 or 2,500 if you're looking at the full market, 2,700, whatever it is. And you're going to choose a subset that because of whatever characteristics you like, is going to outperform that benchmark. And there's been endless research done on this. We talk about how markets are micro efficient, but macro inefficient. And that just means that the efficiency in the stock selection market, the micro market, is such that it's really difficult to outperform, right? We've seen all those SPIVA reports that come out every year, how many active managers are able to outperform. It's
Rodrigo, I
really
just pictured these value managers, back in the back of in their office, hanging their heads, and the growth managers walk by and they're hiding behind their shelves and they don't want to look at them. And all the growth managers are all huddling around the water cooler, high fiving
high
each
fiving.
other.
Yeah.
And then, a year goes by and then all the growth managers are hiding behind under their desk, while the value managers are walking by with the head held high and strutting and high-fiving each other at the water cooler. But it just ends up being this, from growth to value to growth to value. And over time, because the stock picking orientation is so much more efficient, there's not much to eke out of that, right? But the fact is that there are just very few players in the global investment landscape that have the mandate flexibility and the agility because they've got a small enough portfolio to be agile in moving around the capital in their portfolios to be able to take advantage of those macro anomalies, macro inefficiencies like trend following, global carry, et cetera. So
Mhm.
like I think this is just a way more inefficient area to operate with more sustainable, larger premia over time. And
But
it's
let's
nice to
just
be able to
can I
offer
just
that as an alternative.
I wanna yes and this, Adam. I wanna say, look, if you have the wherewithal, and if you're willing to invest in some of the more concentrated, for example, value ETFs that Alpha Architects puts in, right? 40 concentrated stocks, you know, you may be able to outperform. You will likely, if history is any indication, and intuition and how valuations work, you should eke out a positive rate of return. That'll be painful but useful. But what does that pain do? Like, you can do it. Okay. Let's give them the benefit of that. And people who want to follow that should. And if you want to beat a benchmark, that's a way of doing it that you should pursue if that's your passion and you can stick to it. But let's take the value concentration, for example. When you measure the beta of a value ETF like that, you find that the a lot of the variance is not explained by, or a portion of the variance is explained by the beta of the market, and another portion of the variance is explained by the value factor, right? What that means in essence is you're not taking the 15 ball risk of the market, you're taking 20-25% volatility in order to achieve that excess return. Right? You're taking more risk to get more return. And so for you to achieve higher returns against a benchmark, oftentimes it means that you have to take higher risks. So if you're into that, more power to you. Go do that. But let's
If
diversify
you're
our
into higher risk,
yeah.
go for it.
But let's think about another way of trying to do that, right? And this is where I come in now with this concept of stacking. What if you're not about stock selection, right? You want the S&P 500 and beat it. Okay. Well, what if you were to find stacks that had a positive expectancy most years, but also had the benefit of being lowly correlated to the S&P 500? Okay, well, what does that mean in actuality? If that indeed comes to fruition, is that you will over time stack a return that is above the S&P 500, but because of that low correlation, you may not actually be taking higher risk to achieve that excess return. You may, in fact, be reducing drawdowns. You may be, in fact, maintaining, or even maybe you're slightly increasing your volatility because you are stacking depending on how big your stack is. But it's just, if you're not into the game of all terrain and all weather, but you're into the game of outperforming the S&P or the global market, then this is just another way to try to do that. And
Exactly.
I'm super excited by just that. And you don't have to take that. It's your tracking error is low. You're just saying, hey, we're going to try to be the benchmark. And one way it's going to be value, another portion of our portfolio is going to be growth, and the other portion is going to be return stacking. Right.
I feel like,
I love that.
we've been, people like meat and potatoes, right? And we've been like, yeah, man, but you got to try Thai food and you got to try this Indian curry dish and you got to do this and that. And, instead it's like, dude, just add a little gravy, right? Yes, have your meat and potatoes, right? But you need to try this jus with your meat, right? Or
Right.
this gravy man, is it spectacular. But yeah, I mean, it's just a really good gateway to learning more about what else is out there when you sort of take the peelers off and use your peripheral vision. It turns out there's a lot of different ways to earn a living off of capital markets. And it's great if you can find diversification against those meat potatoes that you've grown to know and love so well.
Sorry to interrupt, but I did want to take a quick second to remind our listeners that the team works really hard on these podcasts. We spent a lot of hours trying to get the right guests, and we do a lot of prep work to make sure that we're asking the right questions. So if you do have a second, just do hit that subscribe button, hit that like button, and share with friends if you find what we're doing useful. Thanks again. Now back to the podcast. Okay. Now, guys, what do we think about the setup? Let's go back to macro for a second and leave people with, I don't even know if you guys have any opinions about the current setup and what to expect in 2024. I
Well, I
certainly
will
do.
say one thing we haven't touched on is we've got a lot of elections this year. I think more countries are going to the polls this year than any other year in modern history.
Oh, I
And
didn't know that.
there's a lot of polarity, right? There's a lot of people with very strong views on both sides of the aisle, and where we seem to be having more trouble than usual coming together and having a consensus. And so there could be a lot more surprises in store this year politically than we're used to. And that also could be a source of volatility in both interest rates and in currencies and potentially growth expectations. And we've also, at the same time, we've got massive fiscal stimulus. You've got the US Treasury running 6 to 8% annual deficits over the next right out to 2032, according to the budget office. And when, the deficit of the government is a surplus for the private sector, that is extra money that the government puts into the private sector year in, year out for it to spend and generate wealth. And, you know, over time, inflation really is too much money chasing too few goods. And so if we continue to put this amount of extra spending power in people's pockets, it's not just the US, the Canadian government, the Australian government, Europeans, the UK. There's just a lot of fiscal largesse out there. And it's not just a supply issue, it's also a excess demand issue. And that's going on as far as the eye can see. And some people have pointed out that maybe, if Trump comes in, he might trim some of the spending side of the income statement, but he's also likely to preserve more tax cuts, right? You get deficits both from direct spending and also from lower taxes, which means that there's less money coming out of people's pockets and flowing back to the government, right? So, there's a lot of reasons, and we're starting to see in
More liftoff.
several key areas that both growth and inflation are ticking up. We haven't even seen, labor is still way behind the eight ball. We had this big price shock, and labor is still catching up. So there's every reason to believe, based on what we're seeing, that over time we're going to see the power of labor begin to reemerge, more unionization, and eventually labor is going to insist on having a larger share of the pie. So
70s
all of these
redux,
things are potentially inflationary.
wage inflation. That's
Well, that's
Yeah,
just
the
sticky.
70s.
yeah,
Wage inflation, the problem is sticky, is what you do that
Yeah.
year, what you ask for that year, you're going to ask for the following year. Right. So it really is, as a Latin American, I can tell you that it's the inflation expectations is a tough thing to kill. That really is a behavioral thing. And this is why Powell wants to signal as much as possible that they're going after inflation aggressively. Um, but it's the story tells it itself. This is again back to what the belief has been for the average person, is that inflation has not gone down. And the more they believe that, and they don't understand that indeed we have tempered inflation, the rate of change of inflation, then the more entrenched they're going to get, and the more they're going to ask for that wage growth to get higher. And that's why the genie is going to be put back in the bottle, not today, not tomorrow, but probably in a few years. And in terms of pricing, right now, it's crazy to me to think that there's over 30% probability that there's going to be 200 points of rate cuts this year. Does anybody have any thoughts on which is it? right? Do we have continued wage growth, strong economy,
We had Andy
fiscal
Constant
spending?
down here in the summer, it was early summer, I think, Mike,
July, I think.
and he had, we were talking about soft landings, no landings, higher for longer. And I think we ran around the table and 8 out of 10 people thought we were gonna be in recession by now
Yeah.
as of last summer. And I remember saying, not with the amount of fiscal largesse that we've got coming down the pipe. There's just way too much money flowing into public purses, for us to have a recession. We are at continue to be sub 4% unemployment rate. The employment rate, number of people out in the economy working is higher than it's been in 15 years. And we've got the government, even while the economy is running this hot, the government is continuing to put 6 to 8% of GDP back into the economy for extra spending. So, I just don't see a recession on the horizon. And as long as equity prices keep going up, then companies have no reason, even if their productivity growth is above expectations and they have excess staff, there's got no reason to cut because, they would just went through this period where it was hard to get workers. It was like a couple of years ago.
Yeah.
It's hard to get the workers you need. So they're likely to hold on to them unless the market forces them to cut to preserve earnings. So all of the things seem to be conspiring for a hotter than expected economy over the next year, not a loose,
And it's
weaker than expected.
Andy's roadmap is bang on. I mean, the way it has to go, right? The timing of it is always what makes it difficult to invest, but the way things have to go in order to have sustainable low inflation is first you have to have, I mean, from here, rates need to go up on the long end, right? That's either it's unlikely given the growth that we have that the Fed's going to be cutting 200 basis points. So I think that's the mispricing that he's talking about consistently. So rates go up, that puts pressure on assets, right? Bonds are going to go down, obviously, at the same time, but then that's going to put pressure on equities. Equities should get hurt. From there, you have a lower demand from consumers. That's going to hurt earnings, right? That's going to allow for the employment market to soften, which is going to allow for a reduction in wage growth, which is then going to lead to a permanent or more consistent, hopefully, reduction of inflation. But that's the order of operations that we need to see historically in terms of a macro cycle for us to finally say, okay, listen, soft landing, we killed it. But those things need to happen. We're not going to get from here to there in 12 months, right? It's going to be
Especially not in with the current structure we have
no.
on the
And
credit side. And
macro cycles aren't months; they're years. Right?
yeah,
I think Bob Elliott talked about the fact that 2008 was not a macro cycle. It was a credit crunch. 2020 was not a macro cycle. It was a negative growth shock. Macro cycles move insanely slowly and take a long time to move. If we look at how people have perceived the outcome of the economy over the last 18 months, like you said, Adam, was it a soft landing? Was it going to be a recession? Now we're talking about soft landing again. Like the variation around the actual macro numbers, the macro numbers have been fairly consistent. They have not changed, with the exception of inflation changes. The employment, the wage growth, um, the amount of fiscal spending, and it's all maintained relatively the same rate. And the only thing that's changed wildly is the narrative around that, right? So I think people need to get prepared for the long haul here. And again, the reason you want to be prepared is because while Andy was right about the order of operations, one felt when you spoke with him that, oh, this is imminent, right? Like this rates up, assets down, that's it. And it happened for 2 months and then we recovered very quickly, right? So it's one thing to know what the order of operations is, and it's another thing to be able to get it right and time it and win. Again, more emphasis on why you need to prepare, first and foremost. Right. Any other
Yeah.
thoughts, gentlemen?
Yeah. The NASDAQ went from like 2,500 to 5,000 in the last 6 months of its run. That's a bubble. And we'll see.
Yeah.
Let's see.
Well, it's crazy. Remember the one we did,
Getting there.
the pandemic portfolio that we had in March of 2020, where we kind of like, okay, what's going to happen here? And we said everything can happen. Again, it's just a testament, like, we don't know. It could be this, it could be that. What happened was not, I think, high in our, guesstimations, right? We knew that we didn't know. But if you were to poll us really at that point, we're like, "Oh, it's probably gonna get worse from here," and it got so good.
We're still
It's really
falling
tough.
short, the Russian debacle, the Thai bot. I mean, the NASDAQ went from 1,400 to 5 grand. We got another
In
100% to go.
1994, August 1994, the US equity market uh, hit the most expensive it had ever been on a PE basis, August of 1994, and
Yeah.
then went on to double again by 1999, right? So absolutely anything can happen. We're not, this is not a prescriptive exercise, but it is helpful, I think, to explore all of the other things that might happen that may not be quite as favorable to everybody's favorite portfolio right
Oh,
now.
I don't think that
I
would
think
be a
that
favorable outcome. The market's going up with that kind of intensity. I'm not sure we have a lot of people who are like, "Ooh, did I ever do good?" And then investing from 2000 to 2014 was like 250% drawdowns with a return of 0,
Hmm.
Well, look,
right?
it's
Again,
how
it's
many
playing those
people
In
that you
US
know
equities, that's
today. Yeah.
exactly the
how many
S&P
people that you
500
know
right
in
there.
2023 that actually participated in this run-up? It happened in the last quarter, right?
Mhm.
I mean, I think the favorite portfolio was cash. Cash was king, 5%. Why would I do
Mhm.
anything else? Why would I take the risk? Boom. 2 months, 20% return. I mean, I don't know anybody that was fully invested for their clients.
Well, this
This
is
is
the
the
other
problem.
thing that we need
Great
to
tale.
re-emphasize. I know you mentioned this earlier, Rodrigo, but we could easily see a situation where the Fed holds or even raises in 6 or 9 months because inflation's reaccelerated. But we're coming into an election. And in all likelihood, Janet is going to allow the amount of bills issued to get way outside any historical precedent in an effort to avoid having to issue long duration coupons to fund the deficits. And therefore, equity markets could continue to do well. So, it takes both the Treasury deciding that they're going to allow equities to drain out, and the Fed saying that we need the economy to run a little less hot in order for the market to capitulate here and coming into an election cycle with what a lot of people feel to be existential things at stake. I think we need to acknowledge the potential for very extreme things to happen.
Amen. Yeah. All right.
Cool.
Well, gentlemen, thank you so much for the 2023 recap. I think we got to do this more often. I really
Yeah.
enjoyed this one. Maybe once a quarter, get back in there. Bring a special guest in. All
All
right,
You
right.
guys
gents.
are special enough.
I guess. All right, guys. Thank you so much for doing this with me today. I know that I pushed for this last minute, but I think it worked out.
That's great.
Any final
Always a
thoughts?
pleasure.
Where can everybody find you guys? Everybody knows who we are. You know,
There
you
it
got
is over me.
Gestalt U at Gestalt U for Adam Butler and Twitter. I got Rod Gordillo P, the worst Twitter handle on the planet. P being my second last name.
Rumor has it your LinkedIn profile's on fire lately, though. You got to find
It is,
Rodrigo
yes.
on LinkedIn these
Rodrigo
days.
Rodrigo Gordillo / Rodrigo Gordillo. And then you're Mike 99 at Mike 99
Mike Philbrick at Mike Philbrick 99
at Mike Philbrick 9. All right,
on
beautiful.
Twitter, that is. But
And for our
most of it's
content, you can always find us on investorshelp.com, on returnstacked.com, where we have a ton of research videos, podcasts that will continue to help you out in your journey. Okay. Thanks, everyone. And we'll see you next week.
rock
Thank you.
on.